Hi, I'm Jimmy. In this video, we're looking at Netflix's stock, ticker symbol NFLX. So we're going to run through the basis of Netflix's business, then we're going to look at some of their numbers, and then we're going to try to come up with a fair value for Netflix's stock using discounted cash flow. Now, one of the reasons that we're looking at Netflix's stock is, as you may have heard, Netflix's stock has dropped a decent amount over the past few months. Over the past 6 months or so, the stock is down about 70%. So this is a really big drop in a very popular name. Now, before we jump in, I actually want to tell you about a website that we're building. We expect to have this website up and running by the end of this June. So within a month or two, this thing should be up and running for the community to start playing with. Now, we're going to kick it off with stocks from all around the globe. So all the major exchanges around the world, we're going to have access to those on this website. Now, the goal of this website is to make it quick and easy to use. You punch in a ticker, it kicks back the fair value using whatever required rate of return that we have. Now, for me, I like to use a required rate of return of 7.5%, and then I add a margin of safety based on my measure of risk for that company. But the site, again, is expected to be customizable, so you may choose to use a different required rate of return. And in future versions of the website, well, we're going to have different ways to value stocks, not just discounted cash flow. For example, ways to value banks. In fact, one of the goals is to have it when you punch in the ticker, the website will suggest to you the best way to value that type of company, whether it's a small company, a fast-growing company, a bank, an insurance company, or typical blue chip stock. It'll run through the gamut of here's the best way to value it, and here's the way to do it. We're going to have videos explaining each valuation method so you can customize it to your liking. That being said, let's jump back to our Netflix analysis. So over the past year, this is Netflix's revenue broken up by region. So we could see that the United States accounts for their biggest portion of their revenue at about 44%. Europe, Middle East, and Africa come in just below that at about 33%. Then we got Latin America, Asia Pacific, and interestingly, they still apparently do the DVD business, which I was surprised by. But either way, that business is going away, so I'm less concerned about that. Now, I do think, and we're going to come to some of the growth in a minute, but I do think that there's less growth opportunities in the United States than there is in, let's say, a region like Asia Pacific. And a lot of that growth will depend on a few different things. For example, some of the drivers of Netflix's business is, first, reliable access to Netflix's platform. So if we consider some developing nations, specifically in the Asia Pacific region where Netflix's subscriber base has continued to grow, even last quarter, which was a bad quarter for them, well, they did have growth in that region. We'll come back to that in a second. But there needs to be reliable access to the Netflix platform. Now, if you think about Elon Musk's push towards, I believe he calls it Starlink, bringing Wi-Fi basically to all different regions around the world, well, something like that could go a long way that in time, more people could be, let's call them potential customers for Netflix's business. Overall, this is a good thing. On the negative side, you have account sharing. Account sharing is exactly what it sounds like. It's when you sign up for Netflix and then you give your password to your friend, to your family, or something like that. Well, that's one less customer that Netflix has, and that's going to be somewhat tricky for Netflix to combat. They've known about the problem. They've talked about the problem for a long time, but it's very difficult for them to combat. Another component to consider is the general economy. Most people, Netflix is going to be sort of an added expense. If the economy were to enter a recession, well, it's very possible that one of the expenses that somebody cuts is Netflix. And the last one, and probably the biggest one on this list, is increased competition. So in the past few years, platforms like Disney+, Hulu has continued to grow. The more recently formed Warner Brothers Discovery Company, YouTube, there's lots of different competitors to Netflix. And a lot of those companies have fantastic, if not platforms, even if those platforms are just being developed, they certainly have fantastic content. I'm thinking Warner Brothers Discovery and their whole HBO business, and Disney Plus and their Marvel and all their Disney movies, and they've got a lot over on that platform. So increased competition is surely going to be an issue for Netflix in the long run. That being said, let's switch over to some of their subscriber numbers. So these are their subscribers on a quarterly basis going back to 2017. Now, just to clean things up a bit, I'm going to zoom in over here just so we can adjust the scale here and try to make things a bit more readable. Now, the big number that everybody seems to be talking about, the most recent drop in Netflix's stock, came during the most recent time period where they saw their first decrease in subscribers. They lost about 200,000 subscribers in the past quarter. Now, they did lose about 700,000 subscribers thanks to all the terrible things that the Russian government is doing over in Ukraine. So, of course, that was unexpected and did hurt the business. Now, Netflix's management also came out and said that they expect to lose about 2 million total subscribers. So, that certainly brings up the fears as to the overall trend of their business. And yes, the most recent quarter was the most recent sign that perhaps the fantastic growth that Netflix's business has seen from a subscriber basis will not continue. That being said, let's now jump over to some of the revenue. So when we look at the revenue from 2007 going through analyst estimates up to 2023, analyst estimates are the green bars, and clearly the trend overall is moving higher. Now, these are annual numbers, so the most recent number, the most recent quarterly number, although there was an increase in revenue in that number, well, that's actually accounted for in the fiscal year 2022 estimates. But if we were to continue out further and we were to look at what analysts were continuing to project, what they are as of yesterday continuing to project, well, it seems that it looks like analysts are expecting for this trend to continue even higher. They have growth around the 10 to 11% range every year over the next few years. Now, I actually think that this is a bit aggressive. So if I were adjusting these numbers based on my research, I would probably lower the growth. I think that competition is going to impact things a bit more over the next few years than analysts seem to be projecting. I would probably adjust these numbers to get rid of some of the growth. Now, perhaps I'm wrong, but either way, I just think that analysts were projecting. I think that there might have been a bit too much optimism there. But again, that's just my opinion. Now, a more important number than revenue is how much free cash flow can a company generate. Now, free cash flow is essentially the cash that the company has to either pay back debt holders or stockholders. In our case, we're looking at investing in Netflix's stock, so taking a peek at their free cash flow makes a lot of sense. Now, we can see here that overall things have been fairly volatile for Netflix's free cash flow. But the most important, and to me, the most interesting number when I'm looking at this chart here, is I'm looking at this time period. This jump from 2019 to 2020 happened, and we could see that there were about negative $3 billion in free cash flow to positive $2 billion. That's a $5 billion swing. Now, at first glance, when we look at this, I know when I first looked at this, I said, okay, well, that kind of makes sense. If we think about what happened in 2020, well, everybody was stuck at home. And with everybody stuck at home, more people are watching Netflix. More people are signing up for Netflix. We saw that growth in their revenue numbers. So clearly that would help at least partially explain this big jump. But as I was doing the research for this video and I was trying to get a better understanding of their numbers, I went to take a closer look at what actually happened there. And although in hindsight it makes sense, for some reason I didn't think of it earlier. And that is that most of the reason for this jump in free cash flow was because Netflix had to shut down their studios in 2020. They shut down their studios, they have way less expenses. They're suddenly not paying the actors, not paying the salaries involved in the studios. They're suddenly not producing any new content. If you stop spending money and your revenue is going up, well, of course, you're going to end up with much higher free cash flow. Now, I actually think that this was one of the drivers that made this stock go so nuts earlier on, because people saw this huge jump and said, oh my God, it looks like things are going to go really good for Netflix. And I'm not sure we truly recognized that a lot of these numbers were only happening because they were not spending on their content. Well, fast forward, and now let's add analyst estimates to this chart. And now we can see that analysts are expecting for some ramp up in free cash flow. Is that possible? Sure, I suppose it is. I do think that it is possible that Netflix goes. But the interesting part about that is, from all of the news I've been through for Netflix's stock, well, it seems like Netflix is ramping up a bunch of new productions, which tells me that it's likely that these numbers are going to be difficult to hit. Now, one of the things that I think is important here is that my issue with Netflix's free cash flow is ultimately the volatility of that free cash flow. From year to year, depending on the content that they're creating, well, their free cash flow is going to be very, very volatile. If they slow things down a bit from creating new content, well, of course, free cash flow might easily hit these numbers, might outperform these overall numbers. But if they did that, revenue, subscriber growth would also likely slow. So, that being said, let's now jump over to our calculation of fair value for Netflix's stock. So here with Netflix's stock, even if we don't adjust their analyst free cash flow numbers, that's what the green numbers are, those are analyst estimates for free cash flow. Well, if we don't adjust those numbers, well, we end up with a fair value for Netflix stock of about $97 per share. Now, if we didn't use my 7.5% and we used their own weighted average cost of capital, well, we get a fair value of about $50 per share. So my bigger issue with Netflix's stock, or even Netflix's business in general, is one, of course, there's a bunch of competition coming into it. I think that is the biggest issue. But the other issue is that Netflix is going to struggle. I truly believe that over the long run, Netflix is going to struggle to consistently stay cash flow positive, because the more money that they make, the more content they have to create in order to get new subscribers and keep getting new subscribers. Well, they have to continue to create content, and that costs a lot of money. Now, I'm not saying that Netflix's stock is going to continue to fall all the way down to $97 per share. I'm not sure if it is. But what I do know is that if they cannot consistently generate free cash flow, dividends are going to be difficult to do. Consistent stock buybacks will be difficult to do. All those things that investors like, basically ways to get money back out of the company, are going to be in jeopardy. Those things are going to be very difficult to produce if the company can't consistently generate free cash flow. And as long as they have to produce tons and tons of content, well, it's going to be very difficult for them to generate free cash flow. Now, in the meantime, the markets may stay very irrational and jump all over the place based on the most recent news from Netflix, as the market likes to do. But for me, unless this stock were to continue to drop a decent amount, I really have no interest in jumping in on a company like this. Now, if you'd like to sign up to get access to this website, which should be up and running by the end of the second quarter of this year, I will leave a link right here and a link in the description below as to how to sign up. Thank you so much, and I will see you in the next video.